The idea of infinite income from investments is certainly interesting. We don't need to go to work to live, and the money we need to live and play regularly comes into our bank account. We only worry about what to do with the money. Whether we buy new clothes, go on vacation, or buy a new car. The idea is of course a beautiful one, and many people yearn for this so-called passive income. That is income without having to put in the daily effort of working. How can we approach passive income? One way is by investing in dividend stocks, which is one of the very popular strategies of many global investors and investment funds. So, what is the problem? Why isn't this investment strategy used by everyone on the planet? They probably haven't watched my videos yet. Welcome to the Invest with Jiri channel, where I cover investing, money appreciation and everything that goes around it. If you are new here, please click subscribe and the bell so you don't miss my new videos in the future. In today's video, we'll look at dividend investing and how to manage it. This is a time-tested strategy and I believe you will enjoy it. Let's get to it. Dividend investing is based on selecting stocks and/or ETF funds that offer payouts in the form of dividends. That is a portion of the company's profits for its shareholders. In this way, the company rewards its shareholders to continue to believe in the company and continue to hold shares and/or buy more shares. For the shareholder, that is for you or me, this way of investing is beneficial for several reasons. First, because to get your money back from the investment, you don't need to sell off the stock or ETF fund and realize a profit. You just need to wait a few years and pay back the original investment deposit through a dividend and basically get all your money back. This will accelerate your ROI, return on investment. Second, the dividend amount increases over time and you get more and more money back. Of course, inflation and devaluation of money come into play, and with regular dividend increases you don't have to worry about inflation. Third, it is a flow of money that is infinite. It is therefore a passive income. You just buy a stock or ETF funds once and then just collect dividends peacefully until death. Of course, we are talking about investing in quality stocks with a long-term dividend payout and increasing dividend. Dividends are paid by companies at various intervals, most often quarterly. However, we have stocks that pay a dividend monthly or annually. As I mentioned earlier, to receive a dividend, all you have to do is own the stock and wait for the record date, called the ex-dividend date. On that day, when you hold the stock, you automatically get dividend. If an annual dividend of say $2 per share has been approved and you own exactly 100 shares of that company, you will receive a gross dividend of $200. Of course, not all companies on the stock market pay dividends, but rather established companies with a long history that may not reinvest all of their money in growing their business. Therefore, technology or biotechnology companies rarely pay a dividend, but their stock growth can be outsized compared to established and stable dividend-paying companies. For example, let's look at the 20-year chart. We have Procter & Gamble and tech giant Apple. Procter & Gamble is not even visible compared to Apple, which absolutely dominates. The most reliable companies showing long-term growth in their dividends without cutting them can pay dividends for decades. We call them dividend aristocrats. For example, IBM, AT&T, 3M. They have paid a dividend for over 25 years in a row, increase the dividend regularly and are part of the broad S&P 500 index. Dividend kings, for example, Procter & Gamble, Coca-Cola, Johnson & Johnson, have similar parameters and must pay a dividend for at least 50 years in a row. Of course, there are far fewer such companies. Once a company introduces a dividend payment into its program, investors expect it to maintain its payout even in tough recessionary times. In fact, the dividend is one indicator of the financial health of a public company. However, whether or not a company issues a dividend is not a relevant indicator of the quality or value of a company. We've discussed what a dividend is, and now we could tell how to distinguish at first glance the yield that a dividend brings to an investor for the money spent to buy a stock. This is a very simple calculation of the ratio of the dividend amount to the stock price. This simple ratio helps us compare stock titles and the dividend yield. Most often, dividend yields range from 1 to 8%. The formula for calculation is dividend yield equals annual dividend divided by current stock price times 100. To avoid having to calculate the dividend yield for individual stocks, we can use the internet to do so. For example, finance.yahoo.com lists the dividend yield for each stock. As we can see, for Protect and Gamble, the stock yield is 2.41% per year. By contrast, Apple's annual yield is only 0.71%. It's immediately obvious which of the dividend yields is more favorable from a dividend investing perspective. Investing in dividend stocks or ETF funds is not only beneficial in the long run for generating passive income. Investors invest in stocks or dividend-paying companies because of a stable and growing income stream beating inflation in the long term. Although dividends are not guaranteed in companies, many investors rely on them as a source of income for retirement. Monthly dividend payments can be stacked by choosing the appropriate title. Simply combine stocks that pay a dividend monthly, quarterly, or annually. Younger years that do not need regular dividend payments can reinvest the dividend income to significantly increase the value of their portfolio. Dividend stocks are also popular because of their higher yields than bonds and while offering the potential for share price appreciation. In the event of a stock market downturn and adverse stock market conditions, dividends paid are a security for holders. If an investor manages to set up his dividend portfolio correctly, he is able to achieve a return of around 4 to 5% per annum and, in addition, his portfolio can grow through share price appreciation. I hope that dividend investing has excited you and inspired you to study further. Some other time we will focus on dividend strategies and use in investing. If you like the video, please give it a like. And if you have any questions about dividend investing, be sure to post them in the comments. I look forward to hearing from you. Have fun and invest wisely.